portfolios will be in domestic stocks. You know, they're foreign stocks for my U.S. clients, but they'll be domestic stocks for you. But, you know, Canada, you know, isn't going to get a completely free pass here. There are problems in Canada. Many of you are probably aware of those problems. They don't rise to the level of the U.S. yet, but they're there. And so it is important that people diversify. Even if you live in Canada, you still need to have money invested around the world. I still think the most dynamic economic growth is going to be taking place in Asia. And there will be tremendous opportunities to make money there. You don't want to miss out on those opportunities. And there are other countries that, like Canada, are rich in resources that will benefit from the growth down there. You know, you want to diversify. You don't want to just have only Canadian resource stocks. There are other countries out there that you can invest in to hedge your bets. You know, when you live in a country, you're working here, you might be deriving a pension here. It makes sense to have as much of the money that you control yourself invested elsewhere, just in case. There are a lot of people that, you know, they work, you know, in America, they're expecting to draw a pension from an American company or Social Security benefits from the U.S. government, and then they take their money and then they invest in U.S. stocks and bonds, and they really are making a huge one-way bet. And unfortunately, I think that that's going to lose. But there's no reason to concentrate that heavily. You can invest it. Hopefully, what we'll be able to do here with Pacific Capital Canada is the same thing we're doing in the U.S., which is giving retail investors broad access to the world stock markets, and not just through stocks that trade on your home exchange in Canada. There are going to be some foreign shares that trade up here. But by and large, most of the stocks that we look at don't trade in the United States. They don't trade in Canada. You have to go to their local markets to buy them. We'll be able to bring you those stocks and individually accounts where you can develop your own portfolios with our guidance. And sometime soon, here in Canada, you'll be able to access our managed accounts and our mutual funds. That's still in the works, but it should be ready relatively soon. Now, before I will take a number of questions, but I'll give you a little bit of a rundown on where we stand in the U.S. And what's going on with the global economy, because probably the most important factor right now in that economy is the U.S. And I think I'll let you know what my take is. I mean, a lot of people are assuming that the worst is over, that, you know, we dodged the bullet, the government, we were standing at the verge of Armageddon. It was about to be the worst depression. There was going to be another Great Depression, and our fearless government officials came in, and thank God they bailed everybody out, and printed a lot of money, and now we avoided the worst of it. And now the economy is getting better. And that's a fairy tale. That's not what's happening. The reality is, we didn't dodge any bullets at all. In fact, we're about to step on a landmine. And the economic crisis that's coming, and it might come in 2011, we might make it in 2012, it's no way to know for sure. There are a lot of variables that you can't know in advance. But the real crisis is coming. And I saw a few copies of my book, Crash Proof, floating around out there. And if you read that book, you understand that what happened was not the crash that I wrote about. I wrote that it would happen, but I wrote that it would set up the crash. We've had the tremor, but the earthquake is coming. And I wrote in that book that the most likely cause was going to be the bursting of the housing bubble. In fact, initially, when I first thought about writing a book, I was going to write just about the housing bubble. I was going to write a whole book about it. And I was trying to come up with titles, you know, The Coming American Nightmare, because everybody said it was the American dream to own a house, and I said, well, you know, it's about to be a nightmare. But I didn't necessarily know how I was going to monetize a book that just predicted the collapse of the housing market. So I wanted to have a broader book that had investment themes so that I could use it as a way to generate clients. So the part about the housing bubble was condensed to a chapter, although I referenced the housing bubble in various parts of that book. So I thought that what was going to happen was that the housing bubble was going to burst. And when it did, it would be a lot different than when the stock market bubble burst. Because when the stock market bubble burst, people were pretty much gambling with their own money. And so the people who lost were the people who bought these stocks. And it didn't have broader implications for the financial markets. It certainly had implications for the people who were foolish enough to buy those .com stocks. But it was very different in the housing market because people were buying, gambling with other people's money. And so I knew the big losers in the real estate collapse were not the people who bought the houses, but the people who loaned them the money. You know, because every house comes with a free put. You know, you have your down payment. Once you lose your down payment, then the rest of the losses go to the lenders. And I knew a lot of Americans were buying with nothing down. So the lenders were taking all the risks. And I knew that when the bubble burst, it was going to take down the banking system. I knew that it was going to bankrupt Fannie and Freddie. And I knew these were going to be devastating realities that nobody really could see. And to me, it seemed so obvious. And of course, now to everybody in hindsight, it's just as obvious. But believe me, in real time, nobody believed it. No matter how loud I screamed it or how I tried to explain the problems in subprime and teaser rates and adjustment rate mortgages and liar's loans and no doc, nobody could see it because everybody was blinded by the idea that real estate prices would only rise. And if that were true, if real estate prices never went down and only went up, then my concerns were not warranted. Because after all, if somebody didn't pay for their mortgage, well, you would just take the house and sell it to somebody else, no problem. Nobody believed that real estate prices could fall. Well, they fell, and now everybody can see it. But we have the same situation going on right now, but people still are blinded to what should be obvious. It will be obvious to them, you know, once the next crisis happens, but it's not obvious now. So what happened? So we had the collapse of the real estate market, and the financial firms failed, as I predicted they would. And then in Crash Proof, I wrote that we had two choices. We could allow the banks to fail, we could allow Fannie and Freddie to fail, or we could bail them out. And I didn't know for sure what they were going to do, but I thought that they would more likely bail them out because politically that would be the expedient thing to do, and unfortunately that is exactly what they did. I also said that the government was going to try to reflate the housing bubble with cheap money, low interest rates, and that's what we got. Interest rates were lowered to 0, which is even lower than the 1% that happened in the stock market bubble. So I said all this was going to happen. And then that was going to precipitate the real collapse, because that was going to bring about the collapse of the dollar, the collapse of the bond market, and then we were going to have a much larger economic crisis. And you can see that even playing out on smaller scales now in other countries. You can look at Ireland. Ireland is basically bankrupt, and the question is, will Europe bail Ireland out, or will Ireland default? But Ireland got into trouble because their government bailed out their banks. Now, their banks got into trouble because they made too many bad real estate loans, just like our banks. Why did they do that? Well, interest rates were very low in Ireland, just like they were in the United States. We caused that problem. We have the world's reserve currency. We kept our interest rates artificially too low. Other countries made the mistake of keeping their interest rates low so their currencies wouldn't rise too much against the dollar. And so we sent out our bad monetary policy, infected the decisions all around the world, and we pulled everybody into this bubble. But had Ireland simply allowed those banks to default and allowed the creditors of those banks to lose money, Ireland would not be in the trouble that it's in today. This is the same situation in the United States. Had we allowed banks to fail, had we allowed lenders to lose money, had we allowed companies to go out of business, the recession that we had in 2008 would have been worse. Statistically, we might still be in it, I don't know. But at least we would be repairing the damage. Because the recession is the market's way of curing the disease. The disease was that we spent recklessly, we borrowed money from the world, that we used it to buy consumer goods. We didn't save enough, we didn't produce enough, we did everything wrong during the preceding decade. That's when everybody thought the economy was great, because we were spending all this borrowed money. I knew that it couldn't last because we were spending borrowed money, and we weren't investing that money. It's different. If you borrow money and build a factory, that's one thing. But if you borrow money and buy a plasma TV, it's totally different. And that's what Americans did. we shop. You know, there's an old expression, you know, shop till you drop. Well, we did it. And that phony economy came to an end. But all we're doing now, when you look at the economic statistics that we have, people are now convinced that the worst is behind us. All they're doing is looking at the measures of spending. They're looking at GDP and they're seeing Americans are spending more, the government is spending more, so the numbers are higher. The unemployment numbers are not as awful because a few people are finding jobs as a consequence of the fact that we're spending this borrowed money. But ultimately, the effects of that artificial stimulus wear off. It's just like a drug. It's going to wear off, and then the hangover is going to set in, and the U.S. economy is going to be headed back into recession, only worse than before because we're in worse shape. We took on more debt as a nation than we had before. Some of the debt has been transferred to the Federal Reserve from some of the banks, but the debt is still there, and in fact, it's growing. Meanwhile, the government has not allowed market forces to rebalance our economy, so we're not moving back towards a savings-oriented, production-oriented economy. Quite the opposite. The government is not allowing that to happen, and the government is growing dramatically in size. And that is part of the problem, because the bigger the government gets, the government has to take resources out of the private sector in order to sustain itself, and those are the resources that we need to transform our economy. Now, what a lot of people aren't paying attention to are the interest rates and the vulnerability and the dependence that the U.S. economy has on interest rates. The coming crisis will be, again, much like we're seeing in Ireland. Ireland wasn't having a crisis a year ago. Nobody was really talking about it. The debt was still there, but nobody was worried about it. Well, now they're worried about it, now it's a problem. Because worrying about the debt means rates go up. And when rates go up, the government can't afford to pay. Just like in the mortgage market. The subprime mortgages weren't a problem until they reset. And when the teaser rates expired and people couldn't afford to make the payments, it was a problem. It was always a problem from the beginning because those rates were going to expire at some point, but no one cared about it until it happened. The same thing is going on with the U.S. government. No one really seems to care about the debt that we have. But when they care, it's too late. And you would think that our creditors would wake up. Because right now, you probably heard the news up here, we have something called a debt ceiling in the U.S. And there's some newly elected congressmen that are threatening to vote against increasing the debt ceiling, meaning that we can't borrow any more money. And what our government is saying, what the president's advisors are saying, and what key congressional leaders are saying is, no. We have to raise the debt ceiling, because if we don't raise the debt ceiling, we're going to default on our debts. So what this really amounts to is an official acknowledgement that we're running a Ponzi scheme. America is saying, we will continue to pay our bills as long as we can borrow the money to do it. But the minute we can't borrow anymore, well, then we're not going to pay anybody back. Right? The government isn't saying, if we don't raise the debt ceiling, we're going to have to cut spending so that we can pay our bills. The government is saying, if we don't raise the debt ceiling, we're not going to pay those bills. And this is it. And right now, we are talking about imposing a debt ceiling on ourselves. Eventually, it's not going to be us in doing it. It's going to be our creditors. The creditors are going to say, we don't want to loan you any more money. We don't want to buy any more U.S. treasuries. And what are we going to say when that happens? Well, we just told you what we're going to say. Okay, well, we're not going to pay you back what you already loaned us. Because that's it. It's a Ponzi scheme. As long as the world is willing to lend us money, we'll pay them back with their own money. And as long as they're willing to lend us money, we'll pay them interest. But the minute they don't want to loan anymore, then it's all over. The game's done. And so this is what's going to happen. And what's going to precipitate this? It's going to be a rise in interest rates, and it's going to happen. I mean, you can see interest rates are already rising. And as they rise, we have a $14 trillion national debt. That's just the funded portion. And that doesn't count the $6 trillion or $7 trillion that Fannie and Freddie owe that the government has guaranteed. It doesn't count all the money that the states owe that are, who knows, maybe the federal government's going to step in and start bailing out the states. It doesn't include the tens of trillions of unfunded liabilities because they don't have to make interest payments on those unfunded liabilities yet. You know, unfunded liabilities also include guaranteed student loans. We're going to have a wave of student loan defaults, and so that's going to require government bailouts. Credit cards, there are a lot of financial crises that are coming where the federal government is going to be riding to the rescue with bailouts. So all that is additional debt. But if you just look at the $14 trillion in funded liabilities, right now the government is paying in interest on that $14 trillion less than we paid 10 years ago when the debt was less than half the size. Well, why is that? That's because it's all financed with treasury bills. We've got, I think, $8 or $9 trillion of government debt coming due in the next year alone that we have to refinance. And our national debt is now growing by about $2 trillion a year. That's how much bigger it's getting. Now, the reason that we're able to sustain it is because the rates go up. When the rates go up, it's an entirely different picture. We're only collecting about $2 trillion a year in federal taxes, yet the government is spending close to $4 trillion a year now. $3.5 trillion, a little more. But when interest rates rise, that number is going to skyrocket. But the problem is, when interest rates rise, the economy is going to go back into recession, and so tax collection is going to fall at the very time when government expenditures are going through the roof. When interest rates rise, U.S. banks are going to fail again. The government is making a big deal about how we bailed out all these banks. Well, they're not really bailed out. You know, it's kind of like if you went to a doctor and the doctor said, hey, I saved you, you're in great shape. And you look around, you see that your heart is plugged into the machine, your liver is plugged into some kind of machine, your kidneys are plugged in, you're being fed through tubes, air is coming in. And you say, well, what happens if you take out these tubes? Well, then you're going to die. Well, you're not really okay if your life depends on being plugged in with a bunch of machines. Well, that's what we've done with our economy, with our banks. They're only around as long as the cheap money is there to sustain them. But it can't. And when interest rates rise, and you've got U.S. banks now that are loaded up with mortgages, treasury debt, all this stuff is long in duration, but very low yielding, 4.5%, 5%, 5.5% paper. That's okay when they can borrow from the Fed practically zero, right? And they can make that spread, right? There's a lot of profits that they're making. And of course, they don't waste any time bonusing out those profits to themselves. They don't really give much to the shareholders. But all of a sudden, what happens when interest rates go up? And now all of a sudden, what if interest rates are 5 or 6%, 7%? And they're only earning 4 or 5%. Well, now they're insolvent. Right? Now they're losing a fortune. And what's happening to the value of their assets? Well, their assets are plunging. Because what happens to the U.S. real estate market when mortgage rates are 8, 9%? Well, it completely implodes. Because people can't afford to pay those prices if mortgage rates are that high. Prices can only be high as long as the payments are low. So real estate prices plunge, and these banks are all imploding. So, and then what's happening to consumer spending? The whole economy is unraveling, and rates are going up. So what's the government going to do? They're not collecting the tax revenues. Interest on the national debt maybe goes up from $300 billion that it is today to $1 trillion a year, which could be more than 50% of federal tax revenue. During a recession, it might be even more. So then the government can't pay. The government has to default. Now, when a lot of these banks fail, what's going to happen to the creditors of those banks? What's going to happen to the depositors who are creditors? Well, the FDIC doesn't have the money. So this is going to be a domino effect. And since it's going to be so bad, the government is going to do whatever it can to delay raising rates. So the Fed is going to try to keep rates low indefinitely. But it has to pretend that it's going to raise rates as soon as it's time. But it's all that is pretend. Because the Fed can't admit that it's in a box and it can't raise rates, because then the whole thing would collapse right now. People realize. So the Fed wants to pretend. I remember a year ago, the Fed was talking about their exit strategy. And everybody was, I was right at the time that they had no exit strategy. That it was all a joke. I said it was like the Roach Motel moniker. You know, there was no exit. And all they're going to do is continue to go deeper and deeper into it. I mean, QE2 did not surprise me, and people think, okay, this is the end. It's not the end of it. QE3, QE4. I said they shouldn't be calling them the Queen Elizabeth. It should be more aptly named the Titanic monitor policy. because it's going to sink the economy and the dollar. But they have, the leaders can see, the government can see how bad it's going to be if rates go up. The whole economy is addicted. They cannot pull out those plugs because the patient will die. So now, what is the consequences of leaving interest rates low? Well, the consequence is inflation runs out of control until the point where you can't stop it. And you can already see this happening. Food prices right now are at record highs. They're higher than they were in mid-2008, when, before everything hit the fan, and when apparently all the global economies were all growing strong. Food prices are higher now than they were then, because they are more receptive to the inflation. But it won't be long before energy prices are at record highs, and industrial metal prices, some copper hit a record high, but other metals are not there yet. Certainly the precious metals hit record highs. They're higher than they were. They're also very inflation sensitive. You can see the inflation problems in China. China is experiencing rapid inflation, and it is a problem for them. And right now they're trying price controls. Well, we know that won't work, because price controls target the symptoms of inflation, the consequence of inflation, which are rising prices, but they don't get to the source, which is the increase in the Chinese money supply. They are raising interest rates, which traditionally might combat inflation, but in China's situation it won't. Because by raising interest rates, they simply make RMB deposits that much more attractive relative to dollars. The result is that more money flows into China, and in order to keep the RMB from going up, China has to expand its money supply even faster to absorb the inflow, and now you've got even more inflation. So, in other words, raising interest rates only makes their inflationary problem worse. So China only has one option, and that's appreciation of its currency. And that is going to happen. And it's not going to be long before they figure that out. And when that happens, that kicks U.S. inflation into a higher gear, because we've been exporting our inflation to China. Well, if China doesn't want to import it, America is stuck with it. And so we're going to see prices rise. We're not, the biggest buyer of our bonds is going to disappear. The Chinese now are announcing that they're going to buy a lot of European bonds. Well, they're going to buy that with the money that they would have put into American bonds, but now they're deciding to bail out Europe instead. I don't think they have the resources to single-handedly support two continents. So I think they're deciding that they'd rather place some chips in Europe because they're overexposed to the U.S. So this is a very warning sign of problematic for the U.S. And so what's going to happen is rates are going to start to pick up, and prices are going to start to rise. That's going to put more pressure on the Fed to monetize even more. They're going to start to say, oh, rising commodity prices, rising food prices, they're going to come out and say, that's deflationary. They're going to say this is going to be a drag on the economy. We're going to have to accommodate that, right? And of course, initially, as prices start to rise, the Fed is going to, as they are now, and I said that they were going to do this, they're going to claim victory. We saved everybody from deflation. And thank you very much. Thanks for saving me from being able to buy things for less. That would have been horrible. So thank you. Thanks to the Fed, you get rising food prices, and rising energy prices, and rising healthcare, and rising energy instead of the falling standpoint. But they will say, hey, we saved us. We saved the economy from inflation. In fact, we need to make inflation even higher, just to make extra sure that we don't slip into deflation. But then at some point, it's going to be obvious that we've got too much of what they consider to be a good thing. We didn't just get a little bit pregnant. We're there. And so then the Fed, of course, they can't do anything, right? They can't raise interest rates, so they have to, pretend. But then the cat's out of the bag. When inflation is getting worse and the Fed is still sitting on 0% rates. Now, they might try to raise rates a quarter of 25 basis points, just a little teeny increase, just to pretend they're doing something. But that's not going to matter, because inflation will be accelerating faster than those little rate hikes. So the nominal level of rates doesn't matter. It's the real rate. So even if the Fed is raising rates, but inflation is rising faster, rates are being cut. And so it's not going to work. And so the Fed's going to have to buy more and more treasuries, and to keep the rates from rising. But the problem is the more treasuries it buys, the less attractive they become because it has to create the money to buy them. So it creates inflation to buy bonds, which diminishes their value, which lessens their appeal, so they have to buy more. But the problem is, so the Fed is buying treasuries, it's able to keep treasury yields down. But then what happens is other bonds that they're not buying start to really rise. And that starts to choke off the economy because now municipal bonds are rising. Now when the muni bonds start to rise, there go the states. The states are hanging on by, with just low interest rates. But a lot of U.S. states are insolvent. Their budgets are just complete fantasies. They're like, a combination of, Greece meets Enron, the way they do their accounting. And the only reason that they're able to sustain the illusion is because they got really low rates. But municipal bond rates are going to rise, and you look at what's happening to these bonds already, look at the charts, they're getting clobbered. So the Fed might be forced to start buying muni bonds. Okay, now they can keep muni bonds, but now they have to print even more money. Well, that makes bonds even less credible. And now the corporate bonds are really starting to tank. And now the cost of debt for U.S. corporations, and of course now with the corporate bond rising, stock prices are starting to plunge because their earnings are getting destroyed because they have to spend all their money on interest payments. So now the Federal Reserve is worried about rising corporate rates, so it's got to buy up those bonds, right? And now the Fed becomes the only buyer of bonds. And the more bonds the Fed buys, the more everybody else wants to sell, right? And so then we just completely destroy the currency, and we have runaway inflation or hyperinflation. And at some point between the worst case scenario, the government is going to have to come to its senses, admit its mistakes, and then do what it should have done all along, which is raise interest rates dramatically. But the longer they wait to do it, the worse it is. Right? It's like the more alcohol you drink, the worse the hangover is going to be when you stop. And you can't say the solution is, well, I'm never going to stop. Because then you die of alcohol or poison or something. And so we're going to have to stop at some point. And I know for sure that you can't sober up by drinking more. And for some reason, that's what everybody seems to think, right? Everybody acknowledges now that America got into this problem because we borrowed and spent too much money. But everybody agrees the solution is to borrow and spend a lot more. And somehow, if we add more debt to the existing debt, then we're going to miraculously recover. Now, I think there are some people that think it's just a question of, well, we just need to reflate. Right? We just need to create enough inflation so that Americans can afford housing prices. See, the whole lot of it is that we don't want to allow the free market to rebalance the economy, because the free market wants real estate prices to go down, but the government doesn't want that, because when real estate prices go down, the banks are insolvent. So the government wants to find out, how can we keep real estate prices up? Well, there's only one way: make the price of everything else go up, and then in relative terms, real estate prices will come down. The problem is there's one price that won't go up, and that's the price of labor, wages. No matter how much money they print right now, wages aren't going up because we've got millions and millions of people who are unemployed. And the government is making it more and more expensive to employ them with all sorts of mandates and taxes and regulations. Meanwhile, a lot of the American labor force doesn't really have any skills that have much value. We've taken a lot of our young people and we've kept them in school till they're 23, 24, and we've given them meaningless liberal arts degrees, and they owe hundreds of thousands in debt. A lot of them can't afford to work because that means they have to start paying back their student loans. They'd rather stay in deferment and maybe get an unemployment check or a welfare check or food stamps or whatever they can do. And of course, wages in America are much too high, and they're not coming down. And part of it is the government pay scales have screwed it all up, because people that work for the government, in America, people that work for the government make twice as much as people that work in the private sector. Which is, usually you think of a civil servant as somebody who's paid less. That's why they use the word civil servant, right? They'd be calling them civil masters, when they're earning twice a year. But we have all kinds of laws that are preventing wages from falling, and so the economy is a disaster. So I lost my train of thought. I was talking about something else before I digressed. Where was I? Who was listening? Well, that was before.